Have you been thinking about buying a home and been out mortgage shopping? You know what? Industry research says there's about 6 common mistakes most home buyers make when out mortgage shopping. Please watch this video and I'm going to show you how to avoid those 6 mistakes and hopefully save you thousands of dollars in the process. Hi everyone, I'm Kerry Davies, a licensed real estate professional here in Victoria, British Columbia, born and raised, 3rd generation. I post videos like this every week, so let's get into it. You know, it doesn't matter if this is your first home purchase and you're looking for a mortgage for the first time, or if you've owned maybe 20 houses over the years and you've had all sorts of mortgages. How you structure the mortgage is like super important, and regulations continually change. I'm sure you've heard things like stress tests. That's a new buzzword that is used often now. Applies more so probably for first-time buyers. But there are all other things that have changed, like amortization period. You know, there's 25-year amortization, 30 years, maybe still the odd 35-year around, but that's pretty rare right now. Anyways, having the right structure to your mortgage is like really important, and you really need to understand the product you're getting and how it's going to affect you. Anyways, here are our 6 steps that you must know when mortgage shopping. So step number 1 is getting pre-approved. So what does that mean? Well, getting pre-approved with your lender is you going to your lender. They will going to collect certain documents on you, most likely financial records. They're going to want to know if you already own properties, how much equity you have. They're going to talk about things about down payment. They may be looking for, most likely if you're employed, like if you work for somebody, they're going to want to see pay stubs. Basically what they're going to be looking for is proof of income for you and whoever else is going to be on the mortgage with you. It could be your wife or a partner. If you're self-employed, it's quite a bit different. Probably going to be looking at a couple of years of tax returns and a whole bunch of other stuff. It's quite a bit more difficult. But however, I mean, it's not impossible because there's lots of self-employed people. So really important, get to your lender, get pre-approved, and get it in writing. You want to be able to leave at the end of the day where it's an email, whatever it is, so you know exactly the amount of mortgage you're pre-approved for, so you know what you can afford. The other thing about getting pre-approved, it's really important too, because interest rates do vary, is you want to get a guaranteed interest rate. And this is, very important as well. Reason being is, if their interest rates, say you get pre-approved today, and 3 weeks from now interest rates rise, well, you're going to be guaranteed that rate probably for 60 to 90 days. There might be some lenders who will approve for as long as 120 days. The beauty of this, if rates went down, you could then get the advantage of the lower rate and then lock it in. So it's kind of win-win. Rates go up, you're going to get the lower rate. Rates go down, you'll be entitled to that as well. But keep this in mind, when you're pre-approved, and a lot of people get this confused, they think that they can just go make an offer without subject to approval of financing. That's not true. You are approved, but the lender is going to want to approve the property that you're purchasing. If the property is in good shape or brand new, probably no real concerns there. But if you're shopping for a fixer-upper and there's a lot of issues, you never know, because the property's going to get appraised by the lender's appraiser, and they may report back that, you know what, the roof needs to be done, it looks like some drainage problems, and they may not approve the property. It doesn't happen very often, but it does happen. So getting pre-approved, that's job 1. You do not want to start looking at any properties until you're pre-approved, because you don't want to be out there looking at properties for, let's say, $1.1 million, and you're only pre-approved for a mortgage of $950,000, or if that's all you qualify for. So before you do anything else, go get pre-approved. Step 2, what monthly payments are you comfortable with? Now, this is one that always surprises a lot of people, right? They'll come back to me and say, you will not believe what the bank has pre-approved me for. So there's kind of 2 things here. There are the monthly payments that you are going to be comfortable with, and they're going to be the monthly payments that are going to be a result of what size of mortgage the bank has pre-approved you for. I mean, in some cases, you might feel more comfortable with a much higher payment, but banks are conservative, and they're going to want to make sure that the payments are made and that they get their money back, of course. So they're just, that's also a bit of a protection for you not to overextend yourself. But really, where you want to end up with, whatever those monthly payments are, and usually the bigger the mortgage, naturally the higher the monthly payments are going to be, you want to be comfortable with it. You want to be living with what you feel with is in your means, not the means of the bank. So really important. Make sure you're comfortable with what your monthly mortgage payments are going to be. Step 3, think long term. So what do I mean by that? Well, you want to think how long you figure you're going to be in that property. So I would think you want to figure at least a minimum 3 years in the property. If you're going to be less than 3 years, you're going to probably have to have a bit of a backup plan because real estate can go up and down. The Victoria market is pretty stable for the most part. It mainly has gone up, but have a minimum 3-year plan to stay in the property, and hopefully 5 years. 5 years is always pretty safe. So when I say think long term is because this is going to affect your mortgage, the type of mortgage you're going to have, right? So if you're going to be in there short term, maybe you're going to end up with open mortgage or a closed, as opposed to a closed mortgage. So open mortgages can be paid off at any time. Usually the interest rate's going to be a bit higher. Where closed mortgages, you're locked in for that period of time. Not to say you can't get out of it, but there will be some sort of interest penalty. So these are all questions to talk and discuss with your lender about. Another thing to think about too is when I say think long term, think down the road. What do you think interest rates are going to do? Like right now, they're at historic lows. I mean, I'm hearing interest rates as low as 1.6%. I mean, that's unbelievable. I mean, I used to think 3% mortgages were a fantastic rate, and they were, but it's unprecedented times right now. So if you think interest rates are going to go up, and I expect at some point they're going to have to right now, is maybe you want to lock in for a longer term. 5, 7, you can even lock in for 10 years now, if that rate looks appealing to you. Depending on your nature, maybe you want to go variable rate, and that interest rate will fluctuate with the current Bank of Canada rate. If the rate goes up a bit, then your mortgage rate's going to go up a bit. So, but for some people, you might start off with a lower interest rate because of that. Again, these are all things you want to talk to your lender about and determine what works best for you. If you're the type of person that just wants to know my payments are going to be X for the next 5 years, then go close mortgage, locked in, and just be satisfied with that. Other things to think about, maybe over the coming years, your salaries are going to increase. So maybe you want to go a little bit short term because after a few years you're going to have a bigger, you can increase your payments to bigger. Most banks will let you increase payments at any time and reduce the amortization period. I won't get into those details right now because it can be a little bit complicated. Bottom line is, think long term, think how long you're going to be in that property, have those discussions with your lenders, but also keep in the back of your mind what's going to happen with interest rates. Okay, so let's have a bit of a recap here. You got pre-approved, you're comfortable with your monthly payments, you've had a chance to think about that. You think about long term, what's going to happen down the road. All right, point number 4, understand your payments. So what does that mean? Well, you want to know if you can make, if your monthly payments or your mortgage, has any prepayment approval type of things. Meaning, can you put a lump sum down on your mortgage at any point? A lot of mortgages allow you to pay it down by up to 20%. I think in most cases that's per year, which would be a big chunk for a lot of people. But you never know. Sometimes you come into a bit of an inheritance or have some sort of cash injection. And what better place to try and pay down your mortgage faster if you do that. Other thing, closed mortgage versus fixed mortgage. I touched on this a little bit in the last section. So open mortgage is exactly that. You can pay off any amount of the principal at any time you want. A closed mortgage, that's locked in. Not to say there aren't some prepayment privileges, but you just need to know that. So just so you understand with mortgages, there's kind of 3 parts to them. When you make your monthly payments, a big chunk of it's interest and part of it's principal. So principal is the part that you're paying down the initial balance of your mortgage. So for example, if you start off with a $500,000 mortgage, and once you make your first payment, a certain percentage of that monthly payment, let's say it's $100 of principal, well, now your $500,000 mortgage is dropped by $100. I don't know if that's the number. I'm just using that as an example. Anyway, so let's go to the whiteboard right now, and I'm going to give you some examples of how payments work, how you can adjust them to suit your needs, and probably how to save you a whole bunch of money over the course of that mortgage.
Okay, I was going to use a whiteboard, but I actually found this really good website that helps calculate mortgage payments and how to accelerate them. Pay some extra money, and we'll just see the savings that you can get by doing this. So here's a website up here, or you can just Google something like mortgage payoff calculator, and you'll find some version of it. So what I've used here as an example, 30-year amortization. Amortization is the period it takes to pay off the entire loan. So in other words, I've used $500,000 as our loan amount, and it's going to take 30 years to pay that off. And what are the monthly payments going to be at 2% interest? They're going to be $1,846.03. And that's going to be your total payments over the 30 years. So how about if you just made an additional payment of, let's say, $150 a month? Just by making an extra $150 a month, you're going to save almost $12,000 over that 30 years. It'll pay it off these aren't real accurate, but it's around 20, about 2 years quicker. So that's quite a savings there. Okay. I'll just show you one other thing. Now, so let's say you just want to reduce the, instead of taking 30 years to pay it off, let's pay it off in 25 years. No additional payments. Now, with this, you're going to pay your mortgage off 5 years earlier. Your total payments have reduced down to just $635,000. Now, compared to the 30-year term, I did a calculation here. You're getting your mortgage paid off 5 years earlier, and your total savings is going to be over $29,000. So that but your payment's going to be higher on a monthly basis here. It's about $272 a month higher. So I mean that may be more than you're comfortable with. Just going to show you one other thing here. So right now we've got no additional payments. We're 25 years, but we're paying monthly. What happens if we pay every 2 weeks? And this is called an accelerated biweekly payment, meaning it's you're taking your monthly payment and turning it into a biweekly one. So you actually end up making kind of one extra mortgage payment a year. I think is the calculation. Anyways, so and maybe this works out well for you. Your payment every 2 weeks is just going to be over $1,000. But look how quicker this pays off your mortgage. Oh, come on, get rid of that. Go away. You're going to pay off your mortgage 2 years earlier. So the reason I'm showing this is that there's a way to manipulate your payments. Of course, you're going to have to pay a little bit more, but you can save a lot of interest just by adding, a few $100 a month to your monthly payment. I hope this helps when you think about making your payments.
So step 5, is your mortgage portable or assumable? So what do I mean by that? Okay, so if the mortgage is portable, what that means is, let's say you live in the property for 3 years, but it's actually a 5-year term on your mortgage. And things are going well. You've bought a condo and you want to upgrade to maybe a townhouse or a condo. So you're kind of stepping up in the mortgage, or not in the mortgage, but in the real estate market. So what you want to be able to know is, can you take your existing mortgage that's on your condo, property A, and move it to the next property that you're going to live in? And most cases, that will be allowed, because keep in mind here, the bank wants to keep your business. That's very critical here. So assuming you've been a good customer, been paying your payments every month, doing everything that they expect you to do, I expect they'll be happy to port that mortgage to you. However, make sure that you can. You just need to know that, right? Because you don't want to get find out that you can't move because of a big penalty on your mortgage or something like that. The other thing is the mortgage assumable? And is it assumable with or without qualifications? Now, this doesn't happen all that much anymore, but you know what? With mortgage rates so low, we might see more mortgage assumption coming up there. So what does that mean? It would mean that you were selling your property and the next buyer coming in could assume your mortgage. In most cases, it's going to be assumed with qualifications, meaning that buyer has to qualify for your mortgage. The advantage of that, let's say you've got a 1.7% mortgage rates have gone up to 2.5%. and you need to sell your property, well, it's going to seem kind of attractive if they can assume your mortgage, take over the payments on the mortgage, and in addition, pay you some money on top of that to meet the purchase price. So it's mortgage plus cash equals purchase price. So again, these are important things to think about. Is the mortgage portable, and can it be assumed? And if it can be assumed, what are the terms on that? So step 6 is work with a mortgage specialist. Sounds pretty simple, right? But I tell you what, to me, this is probably the most important step of all, right? What do I mean by mortgage specialist? I'm talking about somebody that all they do is mortgages. Meaning, and in most cases, they're not going to be a salaried employee. They're going to be either a self-employed broker, or a number of the banks do have mortgage specialists, and they work completely on commission. So if they're not selling mortgages, they're not making any money. So avoid going into a branch and working with the person sitting behind the counter and or at in some sort of office, because I can tell you what, the people in the branch are doing all sorts of things. They're doing selling you GICs. They're doing all sorts of stuff, including some will do mortgages as well. Okay, and you'll find that they'll be a lot slower. You want a mortgage specialist working on it. And most of them are mobile, which is the advantage of that is when you make the initial contact, and particularly in these times of COVID, is most of the sort of pre-work can be done over the phone and done electronically. You can send them documents and the type of things they need. Yes, at some point in time you will have to probably meet with that person and sign documents. If you don't know anybody, certainly I can make good recommendations or just ask around. But really, really, really important is work with a mortgage specialist, and it's fine. You can go to the banks. There's lots of good mortgage brokers around. Mortgage broker. The difference here is a mortgage broker can shop the market for your mortgage, meaning they could place it with Scotiabank, they could place it with Royal Bank. They've got probably, 20, 30 lenders at their disposal. If you go to a place like Royal Bank, Scotiabank, you're going to end up with their products. I'm not saying one is better than the other. There's lots of good mortgage specialists at the banks available, and there's lots of really good mortgage brokers who work for themselves. So lots of good options there. But again, if you're not sure, ask me or shop around or ask some of your friends for a good referral. The only difference really between one of the differences anyways between a broker and a mortgage specialist, because the specialist works directly for a bank, they can give you an actual pre-approved letter, right? You are pre-approved. Whereas a specialist, where a broker, they can, do a workup on you and pre-approve you, but you're really not approved until they've sent it to the lender for approval. And that's typically not going to happen until you've made an offer. So again, something for comfort zone, if you want to make sure you're 100% pre-approved, then maybe you should deal with one of the banks or credit unions. However, I'm not saying one's better than the other. In most cases, it's really the person you're dealing with and their capabilities. But this is super important. Work with somebody who all they do is mortgages, and you'll thank me later. Okay, well, that's it. That's the 6 steps you have to know before going mortgage shopping. Geez, I hope you've enjoyed this. If you did, please click the like button down below. Any kind of comments are welcome. I do read them, and I will get back to you. I put out videos like this every week, and if you enjoyed it, please subscribe down below and also smash that bell so you get notified when the next video goes live. Also, if you go down into the description down below, there's a free download down there to a report that I put together, how to get the bank to say yes. It's a much expanded version on how to deal with banks to make sure the financing that you want gets approved every time. Thanks for watching.